In 1933, millions of Americans suddenly rushed to banks and demanded their money back. The problem was that banks didn't actually keep everyone's money in their vaults. Most of it had been loaned out or invested elsewhere. Within days, the entire American financial system stood on the edge of collapse. How could the richest country in the world run out of cash? And why does the same danger still exist today? To understand what happened, we need to go back to the 1920s. America was experiencing an economic boom. Businesses were expanding, stock prices were soaring, and banks were lending money more aggressively than ever. People believed prosperity would last forever. But hidden beneath the excitement was a weakness few understood. Banks operated on trust. They kept only a fraction of customer deposits and loaned the rest. As long as people believed their money was safe, the system worked perfectly. Everything changed when the stock market crashed in 1929. Businesses failed, unemployment exploded, and families began struggling to survive. Fear quickly spread throughout the country. When people heard rumors that banks might be in trouble, they rushed to withdraw their savings. The first bank runs began. Crowds gathered outside banks demanding their money. Seeing these crowds made even more people panic, creating a vicious cycle. Banks were forced to sell assets quickly to raise cash, but many couldn't get enough money in time. One bank failure led to another, and confidence continued to disappear. By early 1933, the situation had become catastrophic. Thousands of banks had already failed, and millions of Americans had lost their life savings. Entire communities watched helplessly as local banks closed their doors forever. Then, newly elected President Franklin Roosevelt made a decision that shocked the nation. He ordered every bank in America to close temporarily. Imagine waking up one morning and discovering that every bank in the country had stopped operating. The bank holiday created panic at first, but it also bought valuable time. Government inspectors carefully examined banks across the country. Strong banks were allowed to reopen, while weak banks remained closed. During this process, leaders realized something important. The real crisis wasn't a lack of money. The real crisis was a lack of trust. People no longer believed their savings were safe. And without trust, the entire banking system was collapsing. Before 1933, several attempts had been made to stop the panic. Politicians gave speeches, bankers made promises, and financial experts tried to reassure the public. None of it worked. Fear was spreading faster than confidence. The breakthrough came when the government introduced deposit insurance. For the first time, ordinary citizens were guaranteed that their deposits would be protected, even if a bank failed. This restored confidence, and slowly the panic began to disappear. Many people think bank runs belong to history, but the same pattern keeps appearing. During the 2008 financial crisis, confidence in major institutions collapsed. In 2023, several banks again faced massive withdrawals as customers rushed to move their money. The difference today is speed. A rumor that once took weeks to spread can now reach millions of people through social media in minutes. Technology has changed dramatically, but human psychology has not. Confidence still creates growth. Growth creates risk. Risk creates fear, and fear can trigger panic. The story of America's banking crisis teaches three powerful lessons. First, financial systems depend more on trust than money. Second, the biggest crises often begin long before anyone notices them. And third, history may not repeat itself exactly, but it often repeats its patterns. The most dangerous part of a financial crisis isn't always the shortage of money. Sometimes it's the moment people stop believing the system works. The government had essentially pressed the emergency stop button on the entire financial system.